All right, good afternoon and welcome to Chamber of Progress's first ever webinar titled FinTech's Competitive Impact, Reshaping Finance Through Competition. My name is Janae Eo and I am the Director of Financial Policy at Chamber of Progress, and today I'll be moderating our discussion. We will be hearing from the perspectives of FinTech industry leaders, consumer advocacy groups, and policymakers from our government's top regulatory authorities. Let's start with introducing our panel. Our first panelist is Kristen Brody with the Federal Reserve Bank of Chicago. Dr. Brody is a senior economist, economic advisor, and director of the Economic Mobility Project at the Federal Reserve Bank of Chicago. Kristen recently served as a fellow at Brookings Metro, performing research and analysis on areas that include the racial wealth gap, the return to education investment, and the disparate economic impact of the COVID-19 pandemic. Next is Marissa Calderon with the NCRC Community Development Fund. She is the executive director of the NCRC Community Development Fund, and she is also chief of community finance and mobility for the Community Development Fund's parent company, the National Community Reinvestment Coalition, where she focuses on advancing economic mobility for communities impacted by systemic inequality and disinvestment. Marissa is currently serving as board secretary for the Hispanic Wealth Project, which has a stated goal of tripling the median household wealth of Hispanics by 2024. Next is Jeff Stoltzfus with Chime. He is Senior Director, Public Policy and Regulatory Affairs for Chime, a financial technology company founded on the premise that basic banking services should be helpful, easy, and free. In his role, Jeff helps drive innovation, inclusion, and access across the financial services industry. He has over 10 years of regulatory policy experience and was most recently at Wells Fargo. Finally, our last panelist is Chastity Murphy with the U.S. Department of Treasury. She serves as Senior Advisor to the Assistant Secretary of Financial Institutions and the Counselor of Racial Equity at Treasury. Before joining the Treasury Department, Chastity worked for Representative Rashida Tlaib as a Senior Economic Policy Advisor, overseeing the work of the Financial Services Committee and concentrating on issues of digital assets regulation, fintech, banking, anti-austerity, financial reform, and financial equity and inclusion. As a reminder, if you have any questions for our panelists, please put them in the Q&A section below. We will be answering all of your questions at the end of your discussion. Thank you. Now, let's get into the questions we've prepared for our panelists. Chastity, could you speak to Treasury's recent efforts to promote competitiveness in the financial services industry?
Sure. Right now, Treasury is very focused on innovations coming from non-bank firms that are beginning to provide financial services. President Biden's executive order on promoting competition requires that Treasury submit a report to the chair of the White House Council assessing the effects of competition on large technology firms and other non-bank company entry into consumer finance markets. The EO was prompt, very broad and open-ended, but we expect the report to primarily focus on the core banking functions in consumer finance, payments, deposits, and credit, and the impact of primary non-bank fintech entrants. We also will provide an overview of the current market landscape, observations on the state of competition, key opportunities and risks related to fintech innovations, and the report will also highlight policy considerations and recommendations for promoting competition and responsible innovation. We do look forward to engaging with everyone on these issues, and hopefully we get some helpful feedback as we roll this out and think through this more thoroughly.
And I really liked in your comment how you mentioned that you're open to feedback, and I just wanted to know if there were any opportunities for people to get involved, through any proposed rulemaking or requests for comments. Was there anything like any open meetings that might come up where people are allowed to, submit a letter for the record?
Currently, we're engaging with people on the ground on this particular report, but we're open to future engagement and open to additional conversations with those as we roll this out. As for whether or not we'll push out an RFC, we're still considering that, but right now we're open to having those conversations at the forefront as we develop the report.
Thank you. And Kristen, what kinds of innovation have you seen emerging in this industry? What has FinTech improved on, and what has generated a lot of change in this industry?
Thank you for the question. And let me just give the usual disclosure that my thoughts and answers do not represent those of the Federal Reserve Bank of Chicago or the Federal Reserve System. So a couple of things compared to things like layaway. Programs like Pay in 4 allow people to split payments but not have to go anywhere, right? So if they don't have transportation, they're not having to go to a store and make various payments. And then if you don't make all of the payments, you don't get to take the product at Christmas time, especially, right? People are trying to make payments to buy gifts and things of that nature. So programs like Pay in 4 mean that people can have access from home. Also, earned wage access means that people can access their paychecks earlier. It means that they may not have to use things like payday lenders or title lenders that charge very, very high interest rates. Of course, there are still reasons for people to go to banks to get provided service, to access credit, to have their questions answered. But we know that there's a lower concentration of banks in Black and Hispanic majority neighborhoods. So it provides access to people who may not have access to a bank or transportation to get to one.
And I would just add with respect to lending in this space that there's certainly a lot of introduction of machine learning and AI in different parts of the process, either in curating pipeline to attract consumers or in some portion of the underwriting and approval process, and even in the servicing process to be able to with the intent, I think, to offer better service to consumers before a problem arises, for example, to be able to engage with interventions, and even when a problem hasn't arisen, to identify when things are going really well and potentially to offer some sort of solution that might be helpful to them in meeting their financial needs and obligations. And that's obviously once they're part of the banking community. But those sorts of things, I think, have a lot of potential, especially if they're approached from a perspective of inclusivity and of understanding how different consumer needs might change across populations.
Chastity, just because you haven't spoken yet, what are some trends you've seen in this space and any potential impact on consumers? Chastity?
I'm sorry about that. I didn't realize the question was directed to me. Can you repeat the question for me? I'm sorry.
No, I wanted to know if you had seen any trends just from your from your bird's eye view at the Treasury Department. What are just some things you've seen emerging in FinTech?
Right now, I mean, Treasury is we've observed that big tech firms have sought mostly peripheral involvement in consumer finance, primarily in payments, and usually in partnerships with IDIs. Big tech firms may be able to leverage their existing relationship in consumer data to enter and expand their so-called data network activities loop and scale rapidly, to ultimately have the capabilities that other, including traditional IDIs, do not have and cannot replicate. So that's what we've observed mostly. And I would say, like, in our engagement with consumer and advocacy groups, we hear a broad recognition of challenges and opportunities with the emergence of these products. And there is a need to understand and manage those risks, and the need for proper oversight and regulation as well as disclosures so that consumers have the information they need to price those risks as well.
Thank you so much. And Marissa, I wanted to now ask you, how do you think consumers have reacted to emerging FinTech competitors with traditional financial services? You see a lot of a lot of apps coming up. You see a lot of neobanks coming up in this space. And so I just wanted to know, what are consumers feeling about these services, and how are they responding to these products?
Yeah, I mean, I think on the one hand, consumers are accustomed to the speed to fulfillment through being able to do a lot of online shopping through services like Amazon. Most of the underserved consumer markets are very comfortable with mobile and social, and tend to use their smartphone tends to be the way that they access the internet, as opposed to on a desktop or a laptop from their homes. So from an advantage perspective, fintechs, kind of meet consumers where they are, that are that segment of consumers that are already some amount of tech savvy and engaged in mobile and social spaces. And because of the way that they can engage intelligently, through curating pipeline based on algorithmically what you interact with. It has a way of sort of creating trust up front that has been a little bit challenging for the traditional financial services model that is brick and mortar, because there's a longer history with institutions that have a brick and mortar presence, and that history has it's informed sort of a complicated dynamic of how consumers that have been taken advantage of in different ways interact with the banking system. On the other hand, because fintechs have been so adept at engaging with consumers and building that early trust, there's certainly more of a potential for taking advantage of that. And while most fintechs, at least in the lending space, don't charge interest rates that approach payday lenders, they're certainly from our perspective would be in some cases either predatory or approaching usurious in how they interact with consumers. So there's sort of a higher degree of potential for taking advantage of that trust, and once the consumer is already engaged with the fintech. So we in the middle there, I think there's a lot of opportunity to be able to serve consumers, to do so in a way that's meaningful and responsible, but that really has to be done with intention.
And I really like what you said there with intention, and about how it's important for these products and services to meet customers where they are. And I feel like, with the presence of neobanks, that's been seen. You have people that are using their mobile phones more often to access financial services. You've seen a lot of people utilizing social media to send money back and forth to each other. And so sometimes that is the best way to move the needle forward, is by just, finding where these consumers are and tapping into that network.
I feel like I have some of the answers to that.
Okay. Would you like to chime in?
Yes. So I guess there are a couple of different examples. I wrote a report about this, I guess maybe a year and a half ago. So some of the things are helping people to stabilize their cash flow, I think, is kind of what he was talking about, that for people who do live paycheck to paycheck, that things like earned wage access can help them to access some of those funds earlier, right? And so we have to think about how that gets paid for. Are there fees? Is there interest? Different fintechs have different ways of doing that, but I can't think of one that charges as high an interest rate as payday lenders. Maybe there are some, but I'm not aware. Things like interest-free buy now, pay later is another one. Helping people build savings with various types of saving cards, or if a person doesn't have a bank account, for people who don't have access to a bank account, or who are not fully banked. And I have those rates here. So in 2020, 13% of the Black population was unbanked, compared to 3% for white people, 9% for Hispanics, 3% for Asians. If we look at fully banked, 59% of the Black community, 88% for the white community, 70% for the Hispanic community, and 89% for the Asian American community. So when we look at who has a bank account, right? So for many of these things, you've got to have a bank account in order to be able to make these payments or a place for your paycheck to go. But what if you don't have a bank account? There are ways that you can go to Walmart or other stores to load money on a card for some of these fintech companies so that you can send money or make payments, right? And again, I'm not saying that these things are better than a traditional brick and mortar bank, but if you don't have a bank account for whatever reason, these fintech companies do provide some other options for communities that have limited access.
And I would also add that for kind of the most underserved communities and for groups of individuals like beneficiaries of SNAP and other public benefits, there are some innovations that I think speak to what Kristen was talking about as well, where you have populations that are unbanked or underbanked, and where a banking relationship may not be that first right step, but a trusted provider is able to receive their different sources of public benefits and give them a vehicle to be able to pay for the necessities of life. That can be a good first transitional step. And those sorts of innovations are sort of more prevalent now than they were in the past, but certainly not a replacement for for being fully banked.
Going back to you, Kristen, I know that, with some of your work, you've done a lot of research with racial equity. And I know that in the aftermath of George Floyd, there have been calls for racial equity in the financial services industry. There was a hearing last June on the aftermath of George Floyd in the House Financial Services Committee. And there was just a comparison of the contributions that big banks have made towards closing the racial wealth gap. I just wanted to give you a chance to highlight, why this is important for everybody to be aware of, why it's, where are there opportunities for fintech companies to bridge the racial wealth gap, and how can we leverage fintechs to help communities build generational wealth?
Sure. So I think even before George Floyd, we had a racial wealth gap. We've historically had a racial wealth gap in this country. People have also talked about how the pandemic has impacted the racial wealth gap. So we know that that's a thing. Now, what can fintechs do about it is another question. But I guess I first want to just look at what is the racial wealth gap. So in 2019, the average white family had a median net worth of $189,100. Hispanic families, $36,050, Black families, $24,100, right? So we still have quite a bit of work to do. The average white family has a net worth of 7.8 times greater than the average Black family. So what can fintech companies do about that? One thing is financial literacy, right? So coming up with programs that they can offer to high schools and college students to teach them about credit, about financial literacy. We know that Black and Hispanic people have lower credit scores on average as well. So thinking about how do we help people save money and also build credit. So the main way that we look at credit is FICO, and some fintechs use various types of machine learning to determine credit worthiness. That's another way, in addition to FICO. They can partner with HBCUs and other liberal arts institutions to share information on their products and also on their hiring practices, right? So we know that a lot of these companies want to diversify, but are they recruiting in places where the people that they're looking for are, right? Like many of these companies are located in Silicon Valley, where the cost of living is very high. So what are they doing to incentivize diverse populations to come and work for them? All of these are things that can be done to increase diversity, not just in terms of the customer base, but also in terms of the worker base at these companies.
And I mean, I would just add to what Kristen said, that the population growth in the country is coming from communities of color. It's being driven largely by Latino and Black populations that are native born, not through immigration. The increase in number of new accounts to banks and to bank-like entities, those increases are coming from these same communities. The potential homeownership gains coming from these same communities. So really there's an economic imperative, sort of if it's not enough of a pull to do the right thing, because there has been sort of systemic inequity that has been the underpinning of our system, then there's an economic really push to do, to make a variety of different changes, because the consumer base is changing and will be entirely, transformed and different 20 years from now. It'll be all of these communities that are presently underserved. And so if for-profit entities want to continue to operate successfully, they will change the way that they do business to be something that is more inclusive and attractive to underserved communities. And in addition to educational, some of the educational things that Kristen talked about, really the way that credit worthiness is evaluated is already something that organizations like CDFIs look at differently, but really looking at alternative means of identifying credit worthiness or risk. Those are important because essentially a lot of the populations we're talking about aren't necessarily more risky, but they operate and interact with our credit systems differently than those upon whom the credit systems were really designed.
Absolutely. I think that's incredibly insightful. And I know that Marissa, I know you and Kristen have, explained very thoroughly what needs to be done in efforts to, build generational wealth for underrepresented communities. And I wanted to also emphasize the importance of making sure that the people that are creating these products are also representative of the people that are receiving these products and benefiting from these products. It's very important. It is very, I would say it's paramount to, the way that this country is shifting when it comes to population growth, when it comes to representation. Everybody has an opportunity to contribute to, generating products that will help everybody. So I'm very appreciative of the efforts that you all have gone to explain that and exemplify that today. I wanted to ask you, Marissa, if you've seen any specific instances in your communities or in communities of color where fintechs have been used to build generational wealth. I know, for instance, there is a new bank called Greenwood Bank, which is a Black-owned neobank. Have you seen anything like that in the Hispanic communities or any other communities of color?
I mean, I think Greenwood is probably the best example of a neobank that is built by the community for the community, engages really authentically because of all of the things that that you referenced, that Kristen referenced. It's that cultural competency that you have from lived experience, because you see the world through the lens in which you've grown up. And so you bring that to how you engage with the consumer population that you're trying to work with. And that, coupled with the sort of financial services acumen that is needed in engaging with populations, I think is incredibly important. The other piece that I think is really, it's often overlooked is really a focus on impact as opposed to solely profit margin. Which is some of how the CDFI community, the lens which was the CDFI community really approaches its work. So certainly neobanks, I think, are have the potential for that kind of impact. There are some, I would say, some interesting innovations from an AI perspective that seek to do a sort of second look on consumers who've been declined for like mortgage products, let's say, and as opposed to being race blind, which in the lending industry for equal credit purposes. That's sort of been the ethos, to be race blind as a mechanism of fairness, and yet we still have a 30-point gap between the white and black homeownership rate. And so, if being race blind has not really bridged that gap, then there are some AI, innovations that seek to at least use some of the qualities that we understand about communities that have been disenfranchised to do a second look and to open up access to credit, in that way, which is again different. And so I think that there's certainly promise and potential with some of those things, but I would certainly caution like the kind of balancing the profit component with the potential for impact, because the communities that we're serving are the growing population of consumers, and so really they need to be done. That needs to be done in a way that is, like I had said earlier, with intent and with an eye toward ensuring that you're not introducing bias or additional bias that's going to disenfranchise people. Yeah, I would say, in addition, one thing that really is missing is really for fintechs and banking services alike, to really invest in understanding bias in the lending process that already exists and in the banking process, and in how to reevaluate systems of risk, so that there can be more opportunity to participate in banking and in lending vehicles for underserved communities.
Thank you so much. Thank you so much, Marissa, for that. And Chastity, I wanted to now turn to you. There are many critics of fintech services that say that there are a lot of challenges. We heard from Marissa and Kristen about some of the ways that fintechs can be used to impact communities. But I wanted to hear from you more about the best way to approach regulation and supervision in this space, because people do say that fintechs come up when there's some sort of regulatory gray area.
Sure. I want to first say that Treasury recognizes that the entrance of non-bank fintech firms into the financial space has really increased and enhanced the consumer experience. So a lot of our considerations have been, what is responsible innovation? Many examples of how fintechs often partner with banking firms are making improvement in consumer finance markets, such as enhanced ability to assess creditworthiness, expanded access, reduce discrimination in the provision of credit through innovation underwriting, greater access to payments. But these developments haven't come without risk. And there's regulatory arbitrage, there's data privacy and security risk of new forms of discrimination, predatory lending, predatory inclusion. There's been digital redlining, digital steering. And so often this results from them avoiding regulatory requirements that apply to other market participants. From a policy perspective, Treasury is focused on whether these new business models recreate the same old risks or new risks without being subject to adequate regulation. From an enforcement perspective, it's important that those firms comply with any applicable rules. And so these issues we're going to continue to assess. And as I said before, we have the competition EO where we'll probably put some recommendations in there, policy recommendations on there on how we think we should be moving forward with these products.
And I mean, if I can jump in and say that, one of the most significant, elements of regulation that the Community Reinvestment Act doesn't apply to most fintechs. When we think about online depositories, assessment areas for online depositories have to be addressed. And we think about that from the perspective of like activities ought to generate like regulation. And many fintechs are not depositories, and thus even when and how CRA affects online depositories, those non-depositories would still largely be unaddressed. And so the fact that there isn't, kind of right regulation in that space exposes consumers to undue risk and to the potential of undue harm.
I think too, I would just add, and I don't want to be too specific, but I guess overall, listening to Chastity and Marissa, there's the issue of regulation trying to catch up with technology, right? And so we know technology and innovation and automation is moving at a very rapid pace. So I think about the way that some fintechs break up payments, right? Like, let's just say that 6 payments is regulated, right? And so it's like, we'll just do 5. Right. So, and that's just one example, maybe, or we won't charge people a fee, but we'll allow them to add a tip if they want to. Right. So maybe there could or should be regulations there, but it's a matter of regulation catching up with technology. Things like layaway or, bank branches, all of those things have been regulated, credit card companies, right? So it took time to regulate those. It'll take time to come up with the right regulations for fintechs as well.
Janae, can I layer in here?
Absolutely.
I think I've secured a better connection. I apologize. Just a couple of things. Such a great points being raised here. I think in particular on regulation, what we see is that the regulation is relatively evenly applied. The supervision is not. And so that's an area, I think, where there's good work being undertaken at the OCC and the CFPB to consider and make sure that the regulators have access to the things they need to have access to ensure compliance with the regulations. And so, for us, what that means is we work with 2 banks exclusively, and everything that we do is through those 2 banks. And so we consider ourselves to be sort of part of the banking system. And so, when it comes to something like Community Reinvestment Act, likewise there, we would like to see our banks better be able to reach into the work we're doing and pull that into their CRA assessment. And so we advocated to that end just recently. So it's a great point there from Kristen and Marissa. And then finally, I would just say, in terms of credit scoring and FICO and the member base that Chime has, what we've done is essentially not used it. And it's not that, FICO has a role, not suggesting it doesn't, but there are ways to provide credit, and there are ways to assist in the sort of journey from, lower scores or thin files to a better circumstance for the individual. And for us, that turns heavily on credit, secured credit. And so there we see users of our secured credit product gain 30 points on average in a relative short amount of time. So great stuff. And I think exactly the right things for us to be focused on.
And Jeff, I wanted to quickly go back to you with the earlier question about where do you see opportunities for fintechs like Chime to differentiate their products and services from big bank incumbents? I know you just mentioned one of Chime's products where the credit scores have increased in 30 points in a short amount of time. I just wanted to know, if you could speak on some of that product differentiation that was discussed earlier.
Yes, I mean, I think what we are laser focused on driving down costs in terms of our platform so that we can provide these services for free. And that, extends across our checking account, our savings account, the secured credit product that I mentioned, all are free. The next evolution, if you will, or the focus, I think, for fintechs and for Chime specifically is that short-term liquidity, and how do the features add up to provide someone who's living paycheck to paycheck to bridge and reduce stress in their financial life. And so it gets very specific, and we see how members, spend down and need that liquidity. And so that's very much our laser focus. As it is, I think, Janae, you mentioned an article noting JP Morgan's focused on that, and we welcome their focus and participation in the process. In many ways, that's part of the competition dynamic that you started on.
Thank you so much, Jeff. Now we have a couple of questions that were sent through the Q&A chat from the audience, and I want to thank you all for sending in those questions. They're very thoughtful, and these are questions that are just open up to anybody. So the first one is, since FinTech will aggregate financial data from multiple sources, what type of security measures could be in place, being that proverbially all eggs are in one basket?
I can take a stab at this. I think that I think we have to definitely consider data minimization efforts. FinTech should be considering data minimization efforts in terms of what data is being collected. Most of that data can be used for machine learning, as I described before, steering, as I've described before. Some of it can actually be used to determine your credit. When we're trying to solve for one issue in the traditional market, we're then thinking about how to solve for this in the FinTech market as well. And so if we can't find ways to minimize the amount of data that's being collected on a consumer, then I think we're going to run into a lot of issues. I would also say that there is at least some concern from me, and this is me talking as Chastity, not as a Treasury official, but I think there is some concern from me, and there has been some concern raised by advocacy groups about what data is even being shared within government. And what that means. What does it mean that ICE has shared some information with DHS, or there's been some information shared, from Western Union to DHS, and what impact does that have on minority and low-income communities? So what data is being collected and how that data is being collected is really important. As we can talk about privacy on one end, but privacy is one side of a coin. The other side has to be data minimization efforts in order to use these services. So I think that's a thing that we should be strongly considering. Oh, and I'll also add CFPB has UDAP authority. There's Reg E, there's 1033. There's things that we talked about, not necessarily in this particular report coming out, but in Section 5 on the digital assets report, we talk about some of the authorities that we've recommended the CFPB, in collaboration with them, of course, that they should use in order to ensure that the consumer is at least aware of the products that are what's being collected on their phones. So I think that's also important as well.
Thank you so much, Chastity. That was really informative. I also see here, is there anything that is being done to address biased FICO scores that are based on geographical locations?
I'll step in. I mean, so just as recently as this week, there was an announcement made with respect to within the mortgage lending space, in particular, the introduction of Vantage Score as kind of as an additional alternative to just the pure FICO model in mortgage underwriting in particular. And so from an advocate perspective, we certainly view that as a step forward, because it is a model that considers other variables that are not just considered within the FICO lending space. From an underwriting perspective, being able to introduce ways of tracking different kinds of payments so that they're not part of your FICO, the potential for tracking your rent payment as a way of establishing a good payment history. Those sorts of things are certainly underway. And then I would say outside of traditional banking and the CDFI space, there are certainly a lot of efforts at using cash flow models to establish creditworthiness as well as there's a fair amount of character-based lending that takes place that in many cases doesn't use FICO at all as an entry point, and then sort of builds up your credit payment history so that you can and begin to engage in building a FICO score, but so that that's not at least a barrier to entry to getting credit products.
Thank you, Marissa. And we have one more question. For the unbanked community, do you know whether it is a technology issue that FinTech is filling or a trust in traditional banking that FinTech may also fill? So is it are people connecting to these products because of its technology, or is it because of their lack of trust in traditional banking?
So I guess I can't speak to the lack of trust part, right? Like, I don't claim to be a mind reader. What I can say from research that I conducted at Brookings is that in many places there are fewer banks, brick and mortar banks in Black and Hispanic neighborhoods, right? A lower concentration, particularly in cities like Baltimore, for instance, right? So what that has to do with trust is almost irrelevant, right? Like, if you have less access to a bank, then what are you supposed to do if there's not one there? I think on the other hand, there are sorts of cards where you can go to a store, another location, and load money onto that card. So that provides access where you didn't have access before. Someone else may be able to speak to the trust part, but in many cases, fintechs are building access for people who may not have it.
And I mean, I would jump in on the trust component. So in the Latino community specifically, and for immigrant communities, depending on your proximity to that immigrant experience. So if you are the immigrant, or if you're a generation removed, and so forth, so some of this changes over time, but based on that proximity to the immigrant experience, oftentimes you've come to the United States from a place that has a different financial services system and structure that informs your perspective on whether and how you should interact with our financial services system and structure. And if you've come from a country, or if your parents came from a country where there was tremendous unrest and there was a lack of trust in that financial services structure because there was volatility in the currency, or your deposits vanished overnight, then that's going to have a meaningful impact on whether and how you engage with financial services here in this country, and really being able to earn trust from consumers who have those experiences is important. And so for immigrants in particular, especially those that may not have status, that is why the Western unions are helpful in moving money, because there's a fear of being deported. And if you in mixed status families where you yourself are not the person that has the status issue, that also informs your perspective on whether and how you engage, because you don't want to cause impact to the people around you who may have the status issue. So I mean, I think it's a little bit of both of those things and other factors that affects whether and how folks are more apt to engage with fintechs. Kind of the anonymity of who you are, and what you bring to the exchange that you have with your bank, and whether the bank is going to discriminate against you based on factors that you can't control about who you are.
Yeah, can I add on to that as well? I mean, the second largest reason that the FDIC has cited that people don't have bank accounts is because they do not trust banks. And this is just adding on to what Bryce has said. I mean, I think there is I just talked about it earlier, there's a larger question of how their information is being used. Banks are obligated to comply with BSA. FinTech's proliferation of FinTechs and how they're being used. Some of them in their partnership with banks also have to report that data, and others don't. I don't think that there is an increase of use with FinTechs because there's a lack of trust here. If people don't trust traditional bank accounts, probably won't trust FinTechs either. And I think that people, just building on what she said, people really appreciate privacy and anonymity. They appreciate cash and the use of cash. And I don't want that to get lost here in the conversation as well. And so I think when we talk about what can be done here, I think in any sort of design, whether or not we're giving people access to bank accounts, whether through the traditional banking system or through fintech, we should always be considering, how do we make sure that the consumer's information is private? How do we make sure that the consumer can trust the institution that's giving them their information? How do they know what information is being shared? I think those are something that draw parallels in both industry. And I think until we can address those issues specifically, people who are unbanked and their reason for being unbanked is that they don't trust a bank account will continue to stay unbanked until we address those issues.
Yeah, and Janae, if I could, I think fees imposed at a moment of vulnerability drives down trust, right? And so that, I think, is key to sort of Chime's trust metrics to date. We surveyed our members on this question, and 70% reported they do not trust traditional banks. And I think that fee dynamic is a large component part of it, and likely why the director at the CPB is so laser focused on it.
Thank you all so much for taking these questions. And I know we're 1 minute over, but I just wanted to open up the floor if any of the panelists wanted to provide any last thoughts or final thoughts before we close out. All right, well, that being said, I just wanted to thank everybody for listening in to this webinar today, and there will be more to come. So please stay tuned. We have an agenda of events and webinars that are coming up down the line. I appreciate everyone for your participation today. Our panelists, phenomenal job. Thank you all.